Hey, welcome to Make Your Money Matter. I'm your host, Brad Barrett, and I'm here each and every week to help you have a better relationship with your money. And today on the show, we're going to talk about 5 ways to value a stock. Now, I've talked about a couple of these before, and I got a lot of comments and some suggestions on some other ways. So I wanted to round out what I would consider the top 5, because there are many ways essentially to value a stock or a company, as I've shared before. But again, I want to focus on these 5 ways that I think we here at One Capital Management as a portfolio manager, we use. All right, we use these on a regular basis when looking at and really deciding whether or not to buy a stock or hold a stock or sell one and what that looks like. But as always, before we get started, make sure to smash that subscribe button and hit the notification bell so you don't miss a single episode. All right, let's get into it. So again, as I mentioned, a lot of ways to value a stock, but I'm going to focus on 5. And the 5 I'm going to go through are price to earnings growth, price to free cash flow, price to sales, and return on equity. Now, these are all great metrics that we here again at One Capital Management, we employ them every day on our analyst team for our portfolio management department. So number 1 I'm going to go through is price to earnings. Now, I've talked about this one before many times, and this has garnered a lot of comments, and I think a lot of suggestions around some further explanation of this, right? Again, I would consider this kind of the granddaddy, if you will, of valuations. That can be subjective, so leave your comments if you'd like. But essentially, the price to earnings ratio tells you how much you are paying for each dollar of earnings of a company. And this ratio is used by investors, by portfolio managers, to compare basically relative values to other companies in their category, their peers, if you will, like in the same sector. So the ratio, the actual mathematical equation that I'll put up here from a price to earnings perspective is the share price of a stock divided by the earnings per share, or the EPS. Now, a good price to earnings is typically, to give you frame of reference here, typically below 20. So I think it's really important as you employ this strategy and you use these kind of scenarios to actually take a look at it, right? And I also want to provide you at the same time a little of a benchmark of what to look for. So number 2 is the PEG ratio, otherwise known as price to growth. Now, I talked again a little bit of this last time we talked about valuing a company, but I want to go more in depth on it today. The price to growth ratio tells you how much essentially you're paying for each dollar of earnings. Now, while we're also focusing on earnings growth in this ratio, so this is why I think it's important to look also at forecasted scenarios, right? You want to look outwards. So this one, it tends to provide a more complete picture than maybe the price to earnings ratio. And this ratio, the actual mathematical formula for a PEG, for price to growth, is the price to earnings ratio, which we've just found out by number 1, divided by earnings growth. Now, a good PEG is typically below the number 1. Now, as you employ these strategies, you'll notice that these numbers I'm giving you on the price to earnings being below 20 and the PEG typically below 1, you'll see when you do the math of the company and where they shake out, and if it's something you want to look at. Number 3 is price to sales. Now, this gets into a bit more of growth strategies here. So the price to sales ratio tells you, or tells all of us as investors, how much we are willing to pay for each dollar of sales versus earnings, which is a little bit different because this ratio also, it's used to compare relative values for companies, again, in the same sector, kind of like the price to earnings multiple. And the mathematical equation for this one is the share price of a stock divided by the sales per share. Now, a good price to sales ratio is between 1 and 2. So again, you can employ this in your strategy. You can talk with your advisor about this to see how the equities hold up fundamentally, maybe in your portfolio. So I think these are good to kind of frame a reference there. And number 4 is the price to free cash flow. So the price to free cash flow ratio tells us how much investors, all of us, or portfolio managers, how much we're willing to pay for each dollar of free cash flow. Now, it's important because I think in all things, well, most scenarios, right, debt is involved in free cash flow and it takes it out of it. So this ratio is run by dividing the share price of the company divided by their free cash flow per share. Now, a good price to free cash flow is typically the number, a data point below 10. So I think it's really important to look at those factors and understand the ratio that you're looking for. And 5th and final is the ROE, the return on equity. The return on equity ratio tells us how well a company is using, I think, its shareholder capital to generate profits. So the higher the ROE, right, the more efficient a company is doing at that. And the mathematical equation for this one is net income of a company divided by shareholder equity. And a good return on equity you want to look for or strive for is somewhere between 15 and 20%. That's kind of the goal marker. So again, I want to bring this up to you. Again, 5 areas. This is very down and dirty, very quick, a great time to get with your advisor, go through your own portfolio to make sure that some of these ratios are being employed across the board from a valuation standpoint. And again, the 5 were the price to earnings ratio, the price to growth ratio, price to sales ratio, the price to free cash flow, and the 5th and final is the return on equity. Hey, I hope you enjoyed that today. If you did, make sure to subscribe to our show. And if you're looking for strategies to get out of debt, check out our course on paying off that debt. The link is in the description box below. And until next time, always remember to make your money matter.